Michael Feroli knows the Fed from the inside. He worked at the central bank in Washington. He's now the chief U.S. economist at JPMorgan Chase. Michael is a Bloomberg Best, one of the most accurate forecasters on the U.S. economy. Michael, we could say that you know what a twisted place the Fed really is. Tell me, though, can you answer the question that Scarlett raised? Can we reconcile the market movements that we've seen unfold since the decision was announced yesterday afternoon by focusing on that one word, significant, to describe the downside risks to the U.S. economy?
I'm not sure about that. I mean, I think we all knew that there were significant downside risks to the U.S. economy. They're just stating the obvious there, I think. I would agree with what your previous guest said, that it did seem like some investors were looking for an outright expansion of the balance sheet, which would imply greater reserve creation, which certainly seems for the equity markets to be something they like to see. But I do think you got the reaction in the rates markets that the Fed would have anticipated from a relatively aggressive Operation Twist.
Michael, so what do you make of, as you just alluded to, the bigger, right? $300 billion is what most people expected. $400 billion is what came. And it seems like the bond market is reacting, if we have to assume, the way the Fed wanted it to, but certainly not the stock market.
Right. In addition to getting $400 billion, we also got the mortgage assets reinvested back into mortgage assets, which is also more aggressive, I think, than most people were anticipating. So,
is that going to make a difference, Mike?
Well, none of these. I think the Fed's been pretty clear that none of these things are going to be a silver bullet for the recovery. But they are incremental, should be incremental financial easings, at least in terms of interest rates.
Mike, thanks for staying with us. So one day post-Fed, stocks are selling off. We talked about that global sell-off. Treasury prices moving higher. We discussed that. I want to get your take on the message from commodities and from gold, because commodities such as oil lower, gold down more than $50 an ounce. Is there some message in the way that those products are trading about the U.S. economy?
There could have been, it's hard to say, right? I mean, there could have obviously been hope for greater quantitative easing than we saw yesterday. I think that could be one message. A second message could just be a realization that the market is finally coming to understand that there's only so much the Fed can do for the economy. I think they've done quite a bit, but beyond a certain point, the Fed can only do so much.
Can only do so much, Mike. It's still held out the possibility of further policy action. QE3 is one of those possibilities. What else at this point could the Fed do, given the fact that they also brought out another tool yesterday, this effort to try and bring down long-term mortgage rates, which most people were not expecting?
Right. I would expect that the next action we could see from the Fed would be to further refine their guidance on interest rate policy in order to more closely link it to observable economic variables like the unemployment rate. A few weeks ago, we had Chicago President Charles Evans lay out a plan somewhat similar to this, and there is some support on the FOMC for this. So I would expect that we could see something like this within the next few FOMC meetings.
And also, I guess, stop paying interest on bank reserves, another thing that was discussed in advance of this meeting, but also a step that wasn't taken.
Right. That remains a possibility. They didn't do that yesterday, of course. So we'll have to see the message we hear from committee members regarding that step in upcoming weeks.
Mike, is there anything that the Fed did or said yesterday that is going to change your outlook for the U.S. economy?
Not really. They did obviously note the significant downside risk, the global financial markets. But I think most people in the markets or who have followed the economy understand those risks. So I think the Fed was just being honest about the economic outlook. So to the extent people are changing their outlook on the Fed statement, I would find that somewhat surprising.
Mike, in theory, this Operation Twist will bring down long-term bond yields. It's doing that. Over time, you would expect that it will raise, perhaps, short-term interest rates. That's not happening. 3-month bills are trading at negative yields. You know this. Should we, at this point, be concerned about another reserve fund-like scenario where the buck gets broken in the money markets and we run into another post-Lehman-like problem?
Right. So interest rates at the very front end have been quite low for 6 to 12 months now, and we haven't seen a major, at least a rapid sort of disruption in the money market. So there hasn't been a big change there, and I would expect any unwind we see in that part of the markets to be rather orderly, which I think from an economic perspective is what is most important.
But no matter how orderly, an unwind in the money market cannot be a healthy thing for corporate America, and not just for corporate America, for the fixed income market as a whole, for funding, et cetera, et cetera. It is such an essential part of the way the economy operates.
Well, I think there's some truth to that, but I'm not sure that, to the extent corporates need to park their cash somewhere, they will find places if it's not in sort of very front-end instruments. So I guess I'm a little bit hesitant to align myself with that position, particularly since we've seen no rapid change in that over the past few days. This has been a phenomenon we've seen, as I said earlier, for at least 6 months now.
Mike, good to see you this morning. Mike Feroli, the chief U.S. economist at JPMorgan. He is a Bloomberg best on the economy. Take care, Mike.